Hello, my name is Jingoneli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
So today we start with the audit of specific balances in the financial statements, and we shall start with the audit of non-current assets. We all know non-current assets. So we first do the planning. In topic 3, they taught you audit planning in ISA 300. And in that ISA, as an auditor, you're required to plan for an audit during, before the audit starts and then during the audit. So planning for the audit of non-current assets. So you first need to know where the non-current assets come from. From accounting field, they taught you that they come from IS 16. That's property, plant, and equipment. They come from IS 23. That is capitalized borrowing costs. They come from IFRS 9, which is financial instruments and specifically financial assets. They come from IS 41. Those are the assets on the farm, like animals and plants. They come from IS 40, which is investment property. And also, they come from IS 28, which is investment in associates. Also, IFRS 3, which is goodwill. And IS 38, which is intangible assets, and many others. So those are some of the standards that give us non-current assets. So while you're planning to audit non-current assets, practically, you have to know that. But also, some of them come from IFRS 16. That is for leased assets. I hope I'm audible enough because somebody is saying I'm breaking. Can you all hear me well?
Yes, sir.
Okay. So these are some of the standards that give us non-current assets. Now, the next thing to do is to download. Now I'm auditing practically. Download the original texts of these standards from IFRS Foundation website. When you're going to audit practically, you need to have, besides you, the original text of these standards. Why? Because you must clearly cite the paragraph in the standard that has been contravened. Which paragraph have they failed to follow? You must know that. Where do you get it from? The original text of the standard. And these original texts are not found in textbooks, but from IFRS Foundation website. You get them from there. They are free of charge. You just create an account, as I told you last time, and download them. The next thing in planning is to know what are you going to audit. For items in the income statement, that is incomes and expenses, here we audit COCAP. COCAP, that is completeness. We test whether the incomes and expenses are completely recorded as auditors. Accountants are supposed to make sure that all incomes and expenses are completely recorded. So accountants must ensure completeness while recording. For us, we come and test whether they ensured completeness. They must record only transactions which occurred, that's occurrence. As auditors, we come and prove that or verify that. They must record transactions in the correct accounts, what we call classification. As auditors, we must come and verify whether they have actually recorded in the correct accounts. So as you audit incomes and expenses, you're checking whether the correct double entry was passed, whether those who work practically or those who have done field attachment, you know that businesses have charts of accounts, and each account is given a separate code. So you are trying to verify whether transactions were posted on the right code, on the right account. That is classification. Cutoff, we want to test whether transactions were posted in the correct period. That is for incomes and expenses because of the matching concept, which is studied in year 1. Matching concept, they told you that we must record incomes and expenses only for the current period, because incomes are only for the current year. They are not carried to the next year. Then accuracy. Please keep your mics muted. Accuracy, we must ensure that the correct amounts are recorded for the transactions. And then presentation, we're ensuring that we have recorded in line with the standards and necessary disclosures have been made. That is for incomes and expenses. But this time we're going to start with auditing assets. So for assets, what are you trying to verify? You're trying to verify assertions of account balances. You studied these assertions in topic 3. So I'm just reminding you. For assets, you are trying to verify COVEP. You want to find out whether the accountant completely recorded all the assets. That's completeness. Whether the accountant recorded assets, where the business controls those assets or has rights over those assets. We don't want you to record other people's assets. You must only record assets you own or assets you have control over, mostly those of substance over form. You know, assets are of 2 types. There are assets which we own. You are the owner and you are the user. Like most of you have your laptops, your phones, your cars. You are the legal owner, but also the user. That asset you have rights over it. But also, the assets where you're not the legal owner, but you are the one using. That one now, like under leasing, like under consignment stock, like under sale and lease back, like under sale and repurchase agreements, like under and many other aspects, like under hire purchase. You're not the legal owner, you're not yet the legal owner, but you're the one using the asset. So there, for those assets, we follow substance over form. There are 2 types of assets where you are the legal owner, again, the one having the commercial value. Those ones are straightforward, they're you as you record. But there are other assets where you are not the legal owner, but you're having the commercial substance, like leasing, hire purchase, sale and repurchase, sale and lease back, and consignment stock. Those ones, you're not the legal owner, but you're the one possessing and using the asset. Like when you lease land, you're not the legal owner, but you're using it, so you record it in your balance sheet as per the substance over form concept. When you go to US and you buy a taxi, you're the one using it. You haven't completed the payments, you bought it on hire purchase. You'll be the one to record it in your books, since we follow the substance over form. So for rights, we look out, are you the one having the commercial substance of the asset? Obligations for liabilities, you must have acquired the liability. The loan papers must be there, showing that you actually got the loan. Then we also verify valuation accuracy and allocation, and also existence and presentation. So this is very key when you're planning for the audit. You must know, what are you auditing? What are you trying to verify? So audit of PPE, we're trying to verify COVEP, as I said up here, assertions of COVEP or assertions of account balances. We're going to test whether there's completeness, whether there is rights and obligations for assets, valuation, allocation and accuracy, existence, presentation. Now, the last part of the planning bit is you must list the documents you need from the client. Which documents must the finance manager avail you? Because you are all going to audit his assets. So which documents are going to give you evidence? One, you need the previous year audited financial statements. and the ML. ML we mean the management letter. So this ML will help you knowing the issues that were there last year. Which issues were there last year? You find them in last year's ML or management letter. And now you are checking whether those issues have been resolved or they are still pending. So this is one of the documents you ask from the client when you're going to audit his or her assets. It will show you evidence of assets that they closed with in the previous year and the issues in the ML that remained outstanding and whether they have worked on them because they had the whole year to work on them. You need the current year's financial statements, but they are still draft because you haven't audited them. They'll only become final after you have given your opinion. You need a trial balance. You need the general ledger for PPE and the rated accounts. You need the asset register. You need the schedule of assets. You need the insurance policies to verify whether all assets are insured. You need the evaluation reports from a certified valuer, confirm that all the assets have been insured as in line with the finance and accounts manual. You need a list of disposed and acquired assets. You need a list of assets with third parties and assets used as collateral. You know, some assets, like they're for movies, but you find them in Chambog. Maybe they hired them. So those are assets with third parties, with another person. You need the original text of the standards. You need ownership documents to verify rights. Up there we saw rights. You need supporting documents for the assets you purchased, like invoices, like receipts and others. You need the finance and accounts manual. This will provide policies on PPE, e.g. depreciation. You want to find out the depreciation rates. You can find them in the finance and accounts manual and other guidelines they follow to prepare the non-current assets accounts. You need the budget because you must see how much money was allocated to the assets and how much has been actually spent. You need the bank statements. So that's what we do when you're planning. You plan, we started from which standards are applying. We looked at the assertions you are testing, the objectives. This question is even common. They ask you, what are the objectives of auditing assets? What are you trying to achieve when you're auditing what? Assets. Assets are liabilities and equity are COVEP. You're trying to verify COVEP. That's just an abbreviation of the assertions for assets, liabilities and equity. Then for incomes and expenses, you're trying to do COCAP, which are assertions of account balances of classes of transactions and events. Any questions? That's now the planning. After the planning, you start to audit.
Excuse me,
yes.
sir.
Yes.
What if this company does not have an insurance policy, or what if their PPE is not insured?
Is not what?
Insured.
Is not provided.
Yes. What if they are?
You, the auditor, you can prepare it for yourself. You just ask them the details. You can prepare it for your own use.
I mean,
yes.
When their property is not insured properly.
When it is not insured, then you raise an issue. You raise a query. Provided the finance manual requires insurance, or even as a best practice, you will now raise it as an audit issue that assets are not what? Insured.
Okay, thank you.
Okay. Any other question? So this is the information you need.
Excuse me,
and
sir.
others, etc. Yes?
Sir, I thought, what is the difference between a PPE schedule and the assets register?
Now, asset register, we record in the asset register when you've just bought the what? The assets. You know the asset register, we put there the code or the ID number of the asset. You put the name of the asset, the location, you put the manufacturer, you put the date of acquisition, you put the useful life. all the details about the asset, both
And
qualitative and quantitative. Then, yes, and that one. But for PPE schedule, as you remember, it is just having the cost of the asset, the accumulated depreciation, the carrying values at the beginning, then the additions, the revaluations, the disposals. So the two are totally different. Asset register comes when you just bought the asset. PPE schedule comes at the end when you're transferring to the balance sheet. I remember you started PPE last year in accounting 3, isn't it? Can somebody confirm that you studied it in accounting 3?
Yes, sir.
So that is it. Any other question? Okay, we'll continue. So I've not listed all the information here. You can always add more of what you want. We can also add body resolution. You need body resolutions. What has the board been discussing on assets? Like if they are selling some of them, you need approval from the board. So body resolutions and others. Now, the last bit of planning is to develop the audit procedures or the substantive tests. Now, practically, we say that you need 5 procedures here. You need analytical procedures, and these are so simple. We said here we just use the word compare, just say compare. And I told you which information to compare. You don't just compare every information. And also you analyze. So this means comparisons and analysis. I told you last time what to compare. So when you're in exam and you're stuck, you don't remember what is in the handout. Just remember here that analytical process. The first test is analytics, and we are comparing. What do we compare? Who can remind us what we compare? Or what we can analyze on PPE?
Opening balance.
compare data and non-financial data.
Next.
Then the actual capital expenditure.
Then next.
We compare the asset turnover ratio for the current year with the previous year.
Yes, next.
We compare the asset turnover.
Depreciation.
What? I've not heard that. Then what do we analyze?
We analyze the PPE general ledgers and confirm that no revenue expenditures are capitalized.
Okay. So those are some of the things we compare or analyze. And all those would be separate points, which would give you different marks. The second test we said we do is the recalculations. When you compare, you find big differences sometimes, which are indicators of risks or material misstatements. So what do? You recalculate those figures. Recalculations. And here we said, so what do we recalculate on PPE?
The
Depreciation.
depreciation of the PPE schedule.
What else?
Depreciation. No. Gains or losses on disposal.
What else?
Increases in valuations.
Yes. Any other? We can also recompute like the PPE schedule, the entire PPE schedule. We can recompute the depreciation, as you said, and all that. So you just get the rate from the manual. If it's 2%, you reapply it. You use your gain, apply 2%, and is it correct or not? Then the next test we said is external confirmation. Or circularization. So as you saw in this information which we listed, there's some information which is coming from external parties. like you see the insurance policies. If you want to confirm whether the assets are insured, you can write to the insurance firm. They are claiming that is the one insuring the assets. The insurance firm will confirm whether actually they hold insurance policies for this company or not. So you can, for external confirmation, you can write the insurance company that has been indicated as the insurer. You can also write to the valuer, this person who valued their assets, certified valuer, to confirm whether actually he did the revaluation, what did he base on. You ask him what was the basis of him increasing the value of the assets or decreasing them. You ask him for value with the copies, because they might have gotten the copies from NASA Road. So you get the actual copies from the person. If you have issues with that account of revaluation, you can also inquire from third parties. So some assets may be held by third parties. You ask them whether they actually hold these assets. They will confirm existence. So this information helps you to come up with procedures. You just look at it, then you apply the procedure. Like I'm looking for external confirmation, I just come and look for the external people here. I can write to. You can also write to the bank. Some assets have been used as collateral in the bank. You want to confirm. If an asset is used as collateral, that means that asset exists. So when I write to the bank to list for me the assets the client has used as collateral, then that confirmation is enough to show me that the asset exists. Because the bank is holding the title. The bank first came and inspected that asset. The banker is holding the logbook. So that is evidence that the asset is existing. Also, these ownership documents, sometimes we keep them in banks, we keep them with other custodians. So we're going to write to those custodians like banks and lawyers to confirm that they are actually holding the ownership documents. We also request them to bring them to us and we look at them and confirm that they are for this client, the names of this client we are auditing, and that will be confirmation that the client owns the has rights over the assets. So we said for this one, what you must remember, now I'm giving you permanent knowledge. You even use it at SCCA, at CPA. So yeah, you say write, and even in your practice, write to. Then they will be confirming that you pass through MOOBS, the best business school in East and Central Africa. So write to, we said you say, obtain confirmation from, we also said it's circularize. You see, most of the top auditors in town have passed through our hands. So you are the next top auditors in the city. Either you start your own audit firm or you can practice in those big ones, or even those are small ones. So that's external confirmation. But before you apply any test here, for example, for analytical, first know, can I compare this information? Then you compare. Or can it be analyzed? Can it be recalculated? Then you recalculate what can be recalculated. Is there an external person to write to? Then you write to that person. Next, we said inspection of documents. So who can tell us how we use inspection of documents, audit assets? Which documents are under assets? And which documents do we agree? Or match?
We agree the asset register.
And what? We agree
General
to what?
ledger. Then we again agree the amount of PP in the statement of financial position to the trial balance and the general ledger.
Yes.
Then we check whether financial lease agreements are matching the lease payment schedules.
Yes. What are you testing there? Which assertion are you testing? When you move forward, which assertion?
Completeness.
Completeness. Then when you move backward. Then when you move backward.
Occurrence.
Existence here.
That is
Here it is existence, then occurrences for incomes and expenses.
Okay, sir.
For example, if I want to confirm that your cows exist on the farm, I will come here to Kampala, you give me a list, then I go to your farm, I move backwards, I go to your farm, start ticking. This one is there on the list, this one is there, this one is not there. Because you have coded them, you know those codes you put on your cows, on your goats. So I start with the list. Majorly, basically, your head office is in Kampala for your farm, the cows are in Nakaseke. So I guess the asset register for the cows and the goats on the farm, you have stamped codes on them, different codes. So I will start with the list, the document, the register, the ledger and the register. Then I go to the farm, start ticking off those that are existing. That one I'm moving backwards to check existence, whether they are there. But if I start from the physical cow, then I check on the list, then I'm testing whether the physical cows exist on the list. They are completely recorded. So inspection of documents, inspection of assets. Then we can also do inquiries and recomputations, or what you call the reconciliations. So these ones you don't have to cram anything to remember these tests. You just have to understand what to compare, what to calculate, what to inspect, and all that. So those are the tests in summary. So I've tried to develop a few for each year. For example, somebody told us we compare opening balances. Now, these are analytical. Where you see the word compare, that's analytical. Where you see the word analyze, that's analytical. For example, we compare the opening balances of PPE in the current year, trial balance. So you get the current year trial balance. See, what are the opening figures there? Are they the same as, because they must be picked from last year's balance sheet, or from last year's PPE schedule. So compare the opening balances in that opening trial balance with the one in the closing trial balance or PPE or statement of financial position. What do you want to establish? You want to find out whether there are any differences, because ideally those opening and closing balances shouldn't have any difference. Even if it is 1 shilling, it shouldn't be there, because you know you just carry the closing balance, it becomes the opening. So if you find a difference, where is it coming from? Now, you tell us assertion you are verifying. Remember, assertions for assets are covered: completeness, rights and obligations, valuation, allocation and accuracy, existence and presentation. So here you're trying to find out, are these opening balances accurate? Did they carry the exact balance? So this one you can never forget, even after 10 years. Then you also analyze, somebody told us we analyze the ML. You get the previous year's ML. ML is not your Benz which you are driving, but it is the management letter. So you get the previous year's, you know, all issues in audit are put in the management letter. All issues we come up with, we put them in a management letter, we write the issue, we show the standard or policy that has been violated. Then we put the implication, we put the recommendation, and then management responds. Management responds. So some issues remain depending last audit. Management never managed to solve them on assets, for example. Now, in the new year, whether we were the auditor last year or not, we shall first ask for the previous year's ML and analyze that ML. Get it, analyze it. Previous year, you find maybe some assets were not coded. So you ask them, let's say, are they now coded? Do they have those codes? Maybe last year, they had not depreciated in line with IAS 16. So now you're trying, have they now this year a depreciated in line with the standard? Because those issues that happened last year are likely to reoccur. That's why you are analyzing the previous year's ML to ensure that the issues in the past are not reoccurring again. Then also, somebody told us that we want to see whether the budgeted amount is the one that is being spent. You know, it is bad budgeting behavior. You start the cost accounting. It is not a good budgeting behavior to spend money over and above the budget or below the budget. You must spend money as per the budget. If you are to exceed, the increase must not be so big. In most NGOs, for example, they don't allow more than 10% increase. Others go up to 20%. If you budgeted to spend 10 million, then it should be 10. If not 10, like around 12, because you know prices keep changing, of course, because of inflation, or they fall. But the differences shouldn't be so huge. Our concern as auditors is if we find very huge differences between the budgeted amount and the actual amount. But if they are small, 10% increase or decrease is okay. But if we find above that, but even that small must be authorized by the responsible authority, e.g. the board. So if we find the differences are so huge, then there's a problem. Imagine you leave money at home for buying items at home, and the budget they made for you is 100,000. But you find when they have spent 1 million to buy the items. Now, first of all, where did they get the money? They might have bought on credit, so they are putting you in debt. You get it? Or if you left them with excess money to do other things, they have transferred the money from another account and they have put it on that account, spend that excess. So have you authorized it? You have not authorized it. So there's a likelihood even they have stolen that money, they have not actually spent on that item. So two receipts. Where did they get the money to expend on that huge increase? One, they might have borrowed. Two, they might have misused the money from another account. Because you left them, 900 is for taking someone to the hospital, 100 for buying food. But you find they have gotten money for going to the hospital and they have added it on food, a lot of money. So they have exceeded the budget with a big amount. As an auditor, that will be an issue which they must explain. If they don't give you credible explanations, then you retain it and you consider it while making your final opinion. So what are you testing here? You're verifying, for example, valuation and accuracy of the figures. Yeah. So for the assertions, you don't have to suffer. Just remember the assertions for assets. They are covered. So you pick one that can be tested by analytical. Analytical most tests most of them. It's a universal test. As somebody told us, you can also compare the asset turnover ratio. Asset turnover ratio from financial analysis, which you studied last year in accounting 3, is about the rate at which we are replacing our assets. That's asset turnover. The rate at which we are replacing our assets. That rate shouldn't be very high. If it is high, that means assets are getting old at a very high rate. They are being impaired, they are being depreciated at a very high rate. Some businesses even, they give an asset 5 years, for example, useful life, but within 2 years, the car is no more. They have driven it so badly, they have used it for excess work other than company work. So they had budgeted to use that car for 5 years, but in 2-3 years, the car is no more. That is problematic. So as auditors, we must look at the asset turnover ratio for the current year and the previous year. If we find that it's increasing, then there's a problem. If it is increasing and also revenue has increased or production, then there's no problem. But the problem is the turnover ratio increasing, they're replacing assets even before their useful lives, but there is no any production increase or revenue increase. So that's an indicator that they may be using these assets for their own work. Workers are using it for their own work to carry their charcoal from the village to go to their own farms, other than using it for company work. So that's why as auditors shall question that and ensure to get the explanations on why assets are being replaced at a very high rate over and above their useful lives. Then you can also analyze the PPE ledger, as somebody told us, and confirm that no revenue expenditure have been capitalized. You're testing for completeness, for valuation, for accuracy, and also It can be forgiveness and others. So these tests alone, you know, Mr. Bialonga can only ask you tests on analytical procedures. He can only tell you to develop 10 tests on analytical, only 1 point. So you can even develop 20 tests. There are many things to compare or to analyze. You can analyze insurance policies to verify amounts that have been used to insure assets. Are they commensurate with the other insurance firms? You get it. You can analyze the repairs and maintenance account to ensure that no assets have been capitalized in that account, have been expensed, sorry, in that account. There are many other things you can analyze. We said you can analyze also related items like assets and depreciation rates. When you go back to the other page of analytical procedures, you can see many other things to analyze. So that is only one test, which is analytical. Any question on that? So we are done with analytical. Then you go to recalculation. You already told us what we recalculate. So the details are in the test. You can recalculate depreciation, as somebody told us, increase and decrease in revaluation, gains or losses on disposal. Then we go to external confirmation. Somebody has put for us cartoons. I think the kids are watching cartoons.
Do you have it?
Helena, can you mute?
You're looking for that too, sir? So what is going to bring the money? It is going to bring the money and eat it ice cream the day when you're going to eat ice cream. Who told you that there will be money? It's okay. Where did you put it?
Yeah, but there's still someone. So just give.
But the rat is going to give you. Don't you know that rats are hiding? But when they come, they'll bring for you money. The rats.
Helena, please.
Helena, can you mute your mic?
Okay. The problem, my hosting rights are not working. I would be able to mute those people, but my hosting rights, I don't know what the problem is. Okay, we'll continue. So after recalculations, you go to external confirmation. As we said, I already briefed you on that. Then you go to inspections and other tests, inspections, and then. So the detailed tests are here. We're going to go through them again as per your notes. So these are the detailed tests. How do we test for completeness? For completeness, we shall normally use inspections. Inspections, you remember, we move forward, you get it. But also we can use analyticals, yeah? But also recalculations. So for example here, the first test for completeness, these tests are similar to what I've just been saying, only now we have grouped them as per assertion. So for completeness, we can get the PPE schedule and agree it to the previous year general ledger. So it is schedule to general ledger. You see, you're moving forward from schedule to general ledger. So you can obtain, if they have already prepared it, just obtain. But if they are not prepared it, because some accountants are also not serious, you find when they have not prepared the schedule. So if they have not prepared it, you prepare it yourself as an auditor. So obtain it or prepare it, you can reconcile it. You can redo those things. Reconciling means redoing. You redo the test, the cost, depreciation, and the carrying amount. You just resubtract it. And then for each category of assets, because remember there is land, there is buildings, property, equipment, and all that. You remember how it appears. Then agree the opening balances for those items with the prior year. You go back the prior year and compare. And also the general what? Ledger. That's when we test completeness. Have they recorded all to the general what? Ledger. From the schedule is just a list of these assets. So from the schedule to the general ledger. So the opening balances, are they complete? Did they carry the way they were from the last year ledger to the current year schedule? Are the correct balances carried? If the correct balances are carried, then there is completeness of those balances. So it is from previous year's general ledger and the other working papers to the current year schedule to compare that the right balances were carried. Then also this other one, you're going to get the PPE accounts, the accumulated depreciation, and the ledger. And then you compare them with the, so this one is all about getting the register. You start with the register. Get the register, then you compare with the ledger. So it is from the register, as you can see the summary here. Get the asset register, check that all the assets on the register have been posted in the PP accounts, then to the GL, the schedule, and then to the balance sheet. So it's simple. A sample of assets from the register, because you know how after buying the asset, you post it in the register, you record it in the register. In the register, there's no any double entry. You're just capturing the details of the asset. Then you're supposed to do the double entry in the accounts where you debit PPE. And of course, these individual accounts go to the GL. GL has the total assets. So from the individual accounts to the total, which is in the general ledger. Then PPE schedule and the statement of financial position. So that's how we test completeness. You follow up an asset from the register up to the balance sheet. If you find it in the balance sheet, then it has been completely recorded. Then a short one, you can start from the physical asset and then trace it on the register. So this is physical asset to the register, as you can see. Then you can also, somebody gave us this one of the lease agreements for the leased assets. Remember, they are also PPE. Start from the agreement. In the agreement, you are leasing cars from Motor Care. You have leased 10 cars. The rate, you remember from in year 2 you started leasing, the rate of lease rentals, maybe it is 10% per year. So is what is in the agreement what is being paid? Yeah. So when you find that what is in the agreement is what is being paid, then that shows completeness, that they are paying all the amounts. Yeah. So finance lease agreements are matched with the payment schedule for the leases. The mere fact that they are paying for these assets, that's evidence that these assets exist. But also want to look at the completeness of the amounts. Are we paying the agreed upon amounts? So get the agreement, look at the payment schedule. Then for the repairs, we want to make sure that no capital expenditure has been expensed. So inspect the repairs account and make sure there's no any capital expenditure there. So you can see all these tests are inspection tests, all of them, and they're all moving forward. Yeah.
Excuse me, sir.
Yes.
There's a scenario when you are testing for completeness and you find that the entity does not have the asset register. What do you do when you're auditing there?
Then that one you will skip, you use the physical assets to the GL. And then the balance sheet, trial balance and balance sheet.
Okay, thank you.
But in the findings, you are going to ask them, you're going to write it as a finding that the entity is not keeping the asset register in line with the finance and accounts manual and IAS 16. Any other question on testing completeness of the assets? So simple completeness, you're trying to find out whether the physical asset is in the register, the correct balances were carried from the previous year, the asset register matches with the accounts, and then the schedule, and then financial position. The lease agreement matches with the payments they're making. And then in the repairs and maintenance, there's no any capital expenditures which have been posted there. Because if you post capital expenditure in repairs and maintenance, meaning the capital accounts are understated. Yes, somebody asking?
Yeah, there are these assets that you may find were written off but have stayed on the asset register.
Now that one you get a list of written off assets or of disposed assets, and check whether they were removed from the asset register. That's another test. Here you must be very creative. Like now that man is so creative. You get a list, obtain, you write it as like this. Obtain the list of disposed assets or written off assets, and ensure that they were removed from the asset register. Or they ensure they don't appear, or check whether they don't appear on the asset register. So you're getting a list of disposed assets and checking to confirm that they don't appear on the asset register. Is it clear?
Thank you, sir.
Okay. Then existence. Now, existence is the opposite of completeness. Here we have been moving forward. We are going to use the same documents. We move backwards for existence. Now, for example, this first test, confirm the entity inspects all assets in the asset register annually. Now, IAS 16 requires that management organizes an asset verification exercise periodically, annually. For example, MOOBs is supposed to do, before even auditors come, the accountants of MOOBs are supposed to organize, of course, with management, an asset verification exercise every year before auditors come for internal use. So when they're supposed to recount all assets available, and they update their register, the asset what register. Before the auditor, you come. So when you come, the first thing you ask them on your auditing assets is, did you conduct an asset verification exercise? They say yes. You tell them to give you the report they came up with. That report will be having assets that were damaged and have been removed from the register, assets that were stolen, assets that are in bad condition, assets that were transferred to the branches, and others. So you analyze that report vis-a-vis the register they have now. That's the first test. You obtain the report on asset verification, analyze it, and confirm that it has been updated. Yeah, the register must be updated in line with the exercise they conducted of asset verification. Then this is the backward movement. You're going to select a sample PPE, especially those of high values, from the register. Then you physically inspect them. So this is from the record to physical. You go with the record, then you start asking, you go to the yard. So where is this car from the register? I'm seeing a car UBC 973M on the register. Engine number, this and this. Open the bonnet. They open, you see the engine number matching. You ask them, is that number plate? There's where I went to audit, and all cars were RAV4s but different number plates. So on the register, there is RAV4. They take us out in the yard. There's RAV4, but the number plates are different. The engine numbers are different. You get it? So you need to open and they show you. So when you start from the record to the physical asset, then existence. You want to confirm whether all assets on record are physically there and they're in good condition, not just being there, but are they working? You can ask them to start it for you. Recently, we were somewhere and the machine was not working. They started it and it was not working, but it was there. So being there alone is not enough. It must also be in good condition and correctly serialized. Then opening and closing balances can also show us existence. If the opening and closing balances are matching, then it can also show existence. Then also for assets that are very far, you go to audit this NGO, the head office is in Kampala. They tell you the asset is in Impondwe with the refugees in Kasese. So, and you, the auditor, maybe the time you are given the money, you can't go there to verify it physically. What do? If it is a car, you can, for example, look at the driver's salaries. If there's a driver they are paying and they're saying it's done who has gone the car, you ask them, give me the payroll for that driver. Now, if they don't have the payroll, that means the driver is not there and the car is also not there. You ask them to give you the repair records. They normally take that car for service. So if there are records, that's evidence that the asset exists. They may have hired out some assets to the customers. Like there are some businesses doing hiring assets. Ask them, they tell you the customer is hired it, the customer is in South Sudan. So ask them to give you the agreements with that customer. You hope in verifying those income generating assets which are not at the business physically, but they are in very remote areas, very far where you can't reach. So those are some of the tests that show existence. Any question on existence or in addition?
What if I use the insurance policies to verify existence?
Yeah, that's also correct. You check, you inspect the insurance policies, there are evidence that the asset exists if it is insured. Any other? You can also use drones. If now, like in COVID, we're using drones. You send a drone, they tell you the assets are on the farm in Jinja. So you send a drone there, it goes and takes pictures and brings you. That's now technology. You get it. We got rights and obligations. How do you confirm that the business is the actual owner, is the real owner of these assets? Here we're going to inspect. Whenever you see a document, just write inspect. Whenever you see documents, just write check, inspect, review those documents, analyze, examine the documents, or agree or match. So to confirm rights and obligations, you're going to inspect the ownership documents. These documents must be in the names of the business you're auditing. And they must be matching with what has been transferred to the register and the ledger. If it is land, land is so tricky. Land is so, the ownership documents for land are so slippery. You can find the CEO already sold the land, but after selling it, he sold, of course, the correct land title. But he goes to NASA Road and gets a replacement, so that when auditors come, he shows them the duplicate one. So guess that land title they have given you sample. If you go to the land office, the Ministry of Land, ask them to confirm whether those land titles are actually existing and in those names. You'll be surprised to find that some of the documents are fake. They tell you that land title was already transferred in somebody else's name. So you can carry out a search at the Ministry of Lands to confirm that actually the names on the land title are the ones the ministry has. Then as I told you, some documents are kept by lawyers. Some businesses are risky to keep the documents, so risky to keep them at their office. They give them to the lawyers and bankers to keep them in custody. So if I'm auditing in Zambia hospital and they tell me the documents are kept with our lawyers for land ownership, for machines, I'll write to their lawyers or their bankers who are keeping those documents, and they do what? And ask them to avail them. So that's external confirmation. For vehicles, you must ensure they are used for the company's work.
Excuse me, sir.
Yes.
Sir, when you talk of confirming with the lawyers or maybe bankers, and there are situations we see collusion within the organization, but it can also go external. How do you deal with it? Because a lawyer might be a friend to me and I tell him that ABCD, we are going to be audited, but just in case in future you're contacted, please say this.
Yes, that collusion is always there, and it can happen. So what do? For you can, if you see that you can see how they're interacting with their lawyers. You can suspect even the interaction, how they talk, or their bankers, their lawyers, and all that. If you suspect that, then you conduct another test. For example, we said like for land titles. Now you can go to the Ministry of Lands and confirm actually whether it is in those names. You can carry out other tests. So it's all about, if that audit procedure fails, you use another audit procedure. We are saying, for example, they may have connived with their lawyers and bankers, show you fake documents, or to tell you that the documents. So first of all, you ask them, do you have the documents? They say yes. Then you say, bring them. If they are connived and the documents are not there, they will not bring them. They will not show up. But if they shows up with fake ones, now you go to the Ministry of Lands and you verify. If it's a car logbook, and write to URA, have you ever cleared this car? Is it still in these names? You can open up use the TIN of the company on the URA portal. You know the URA portal if you own a car. When you go to your airport and you log in with your TIN, you'll find the car there in your names. So if it's a car, you log into URA, you'll be seeing it. If it's land, you write to the Ministry of Lands using that title they have availed to confirm that it is in those names. So I think I've answered you so well, sir.
Thank you, sir.
Okay. Then for mortgaged assets, remember sometimes we buy assets on mortgage basis. Mortgage means you want to buy an apartment in Nigeria. What do? The apartment is 400 million. You go to your bank, Stanbic Bank. You tell them I've identified a house in Nigeria. It's 400 million. I want to buy it. Now they ask you want to buy it on mortgage basis. You say yes. Now the bank will pay the money for you, but they don't pay all the money. They pay like 90% and you pay 10%. Or others even can pay up to 80% for you, pay 10%, 20%. Why don't they pay all the money for you? In the finance, they told you that there is what you call capital as one of the 5 C's of credit. You must also put in your own money so that you feel the pinch. In case you are failing to pay, you are also losing something. It's not only the banker that is losing. So the bank accepts it's 400 million. They pay for you 390. You pay 10. Then the owner of the building gives you the documents, but you don't take them. The bank takes the documents because they have given you a loan of 390 million. Yeah. So you continue. You start paying the bank as a loan. That's what's called mortgage. People can buy cars on mortgage basis. You just take your bank to the bond. They give you the card. The bank pays. Then for you keep paying the bank in installments as a loan repayment. Now for those ones, you're going to audit a company and tell you that asset is on a mortgage basis. Ask them where the ownership documents. They tell you that with the bank. We bought it on mortgage basis. So you write to the bank to confirm actually whether this client has a mortgage with them. Also, you look at the repayment schedules. Are they paying back or not? If they're not paying back, they risk losing the asset to the bank. Then for lease agreements, They also show ownership if they are there, and they are properly classified as finance leases. Then for capital commitments, money put aside for assets, and they have used it. You can look at the invoices, whether they rhyme with the capital commitments in the budget and the minutes. So any question on or addition on rights and obligations?
Excuse me, sir.
Yes.
Okay, like when we are looking at rights and obligations here, we are looking at small farms. How about a situation of small farms where like most of these assets are being bought in the names of maybe the director? How do we go about it? And yet it's a business, it's for business purpose.
Now, of course, for small businesses, you find that the car is in the names of the director, but they're saying it's a company car. Now, there you go back to the business entity concept. Business entity concept in Young, they told you we must separate the business assets with those of the owner. We record them separately and all that. So if the owner decided to surrender his asset to the business, but it is still in the names of the owner, now, one, there should be evidence that he surrendered it to the business. That's when we show the separation of use of the asset. So if there is a document showing that he transferred it to the business, it is no longer his. Yes, it can be in his names because it's hard to avoid that in a small business, but at least there must be a document transferring it or showing that he has surrendered it to the business as an asset of the business. So we shall just need that documentation and also proof. We also need proof that it's being used for company work. There may not be a document because you know how small businesses operate, but there must be proof that it is at least majorly, I mean like 80%, 90% being used for company work for it to qualify to be recorded as a business asset. For the ownership, it can still remain in the names of the owner because of the nature of the business is small and they may not follow all those legalities. But is it being used for company work majorly? Then there we shall apply the substance over form, where the legal owner is different and the commercial owner is also what? Different. One, there must be a document transferring it to the company as an asset of the company, even if it remains in the names of the owner. But two, it must also majorly be used for company work for it to qualify to be recorded as a company asset, even if it is small. Is that one okay?
Thank you, sir.
Okay, now those scenarios that we meet them when we're auditing, what those people are asking. So you should take keen interest. That is the practice.
Excuse me?
Yes.
This last point, capital commitments.
Yes.
Explain for me.
Yes, what is it?
I'm saying the last point about capital commitments.
Yes.
Not picked it well, eh?
Okay. Okay, let me explain it again for you. Now, capital commitments will mean the money put in the budget to purchase non-current assets. Now, you want to prove that the money was spent from the budget and it was spent in the names of the company, because there's a risk that you can put money in the budget and instead of buying assets in the names of the company, we buy our own assets as workers. So that's why I'm saying that inspect invoices received after the period end and the minutes for evidence of capital commitments. Invoices, if they budgeted for the money to buy a new asset, is it in the names of the company? So this invoice should be in the name of the company, but also it should be matching with the capital commitment. If they are budgeted for 20 million, even the invoice should be around that. That will show that, and the invoice in the names of the company. So it will show that we have purchased the company, the asset for the company, using the money that was committed. But also there should be board minutes showing that they committed the money. If the board has committed the money, that's evidence that the entity owns the what? The asset. But if they just buy assets out of the blue, the board never committed the money, then there's a risk that the CEO just diverted the money to buy an asset for himself and not for the company. Is it clear now?
Yes, sir.
We go to additions. We're just repeating most of the tests for additions. The assets they have added during the year. We want to verify that all of them have been recorded at correct amounts, and we have rights over those what assets. So we are repeating the same assertions. So I will not repeat much here. We have already looked at all these ones. You can just go through for additions. And in case you need any clarification on any, I can give you. Just go through. I'm going to give you 2 minutes to go through on additions. Then I explain self-constructed. So those are the tests for additions. Then we got self-constructed assets. Sometimes the business, as you can see, like moves, keeps constructing new buildings. Now, we are auditing those assets which they have constructed. We want to confirm completeness of the recording of all costs incurred. Now, IS 16 tells you which costs to capitalize when you construct the building for yourself, when you make the machine for yourself. So like if it's a building or even another asset, you're going to capitalize the material, the labor costs, and overhead costs. So how do we ensure the correct amounts have been recorded? Whenever you buy cement, there's an invoice. Whenever you buy iron bars, there's an invoice. So as auditors, you're going to find you have constructed a building and you put 1 billion on it. We're going to ask you to bring all the invoices for the costs. Then we match those invoices. After adding them, we match them to the total cost. But also the payroll for the workers, the laborers, the porters, the builders. There's a payroll you have been using to pay them. So we shall also add those costs as labor costs and see whether they have been added. Remember, IS 16 allows the capitalizing of those what? Costs. Then some assets you find they are not constructing a new asset, but it's a major overhaul. An overhaul means like you have a car, you replace an engine. That's an overhaul. You have like a plane, you replace the engine of the plane, and those other major parts. They are also supposed to be capitalized, and we should be seeing enhancement in economic benefits for a major overhaul. It might be a building that has been having 2 floors, you add the 3rd floor. That's a major addition, and we must be seeing increase in revenue for that addition. If it's a car you've replaced the engine, you must be seeing that change in terms of economic benefits. Can the car now carry more tons like that? Then review the cost to ensure no profit has been included. We shouldn't include the profits in costs. So that one should be separated. And also for borrowing costs, they should be you should capitalize them in compliance with IS 23. Remember, in IS 23, there is commencement of capitalization. So did they commence at the right period? Remember the requirements of commencement. When do we commence capitalization? Who remembers? When do we commence? When do we suspend? When do we cease? Because there is commencement of capitalization, there is suspension, there's when you suspend and you stop capitalizing. And then there is when you cease. So those must be done correctly in order to have the correct borrowing costs capitalized. So who remembers when we commence, when we suspend, and when we cease? If you don't remember, you'll have to read the standard again. The original text, it will show you.
So, we commence when the expenditure on the asset is being incurred and when the borrowing costs are also being incurred.
Then suspension.
If active development has been interrupted for any extended period, then we can suspend capitalization for the remaining for those periods.
Then cessation. When do you cease?
When no economic benefit is.
Once all the activities necessary to prepare the qualifying asset for its intended use are complete.
Okay, that's correct. So that one, if you follow those procedures of the standard, you have the correct borrowing, because as auditors, you must check when did they start. Did they start when the expenses were being incurred, and when you started incurring the borrowing costs? Did they suspend? Did you suspend when you're supposed to suspend? Do you cease when you're supposed to cease? So auditors go back and check all that to ensure that the correct amount has been recorded. Then for disposal, how do you audit disposals? One, you check whether the disposed asset has been removed from the register. It must be removed. Remember the first double entry for disposal. You did recognize the asset. You debit disposal and credit non-current assets. So check on the register and confirm that they have removed the disposed assets. And of course the ledger. That will show that the disposal occurred. Then some disposals may not be recorded. They may have remained unrecorded. So you analyze the revenue cash receipts from disposals. Remember, when we sell these assets, we don't take it as revenue. As revenue on sales, we don't add it on sales. It's not a sale. We just debit cash credit disposals. So check whether they have included in revenue any disposals. That will show you that they have not recorded as a disposal, but as a sale, which is wrong. Because this is a gain. Revenue is in two forms. Revenue can be income. Income is in two forms. Income has revenue and gains. Revenue is from the routine activities. Like if you sell for MOOBs, revenue is from the school fees you pay. That's revenue. But also MOOBs has gains. For example, when they sell all the assets, those are gains. So gains and revenues are different, but they are all incomes. So incomes is categorized as revenue from the routine activities, then gains from non-routine activities, like disposal. That one will be a gain. So if you check the revenue account and you find that there is disposal, then that's wrong. They should remove it. It should be in gains. Where we debit cash credit disposal, then determine the profit or loss. If it's a profit, to take it under gains. Then this disposal must have been authorized by the board. So you inspect the board minutes, confirm that. In the future, when you become a CEO, you don't sell assets of the business without approval of the board. Then you must also inspect the documents to ensure that the proceeds have been correctly recorded. You can calculate the profit or loss on disposal. And for depreciation, it must have stopped when the asset was going to be disposed. We stopped the depreciation. And then we must disclose in the notes the details of those assets that have been disclosed. So we review as auditors, we check whether this disclosure has been made. So those are the tests. You read through and get more of them. There's a question here which you can go through and it has its solution. So you go through it. In case of any question, next time you ask me what you have not gotten. We got the next part of today's lecture, which is the audit of intangible assets. Who can remind us IS 38 and IFRS 3? Because those are the standards you're auditing here. IFRS 3 and IS 38. Who can give us a brief summary of any of those? And how they lead to intangible assets? Yes. Somebody remind us IS 38 and IFRS 3. You've all forgotten those standards?
Just come.
Okay. Why tell her to come in?
I can go and pick them.
Can go and pick it.
Alvin, tell your girlfriend to mute.
Someone is coming to pick it. Someone is coming to pick it.
Okay, IS 38. If I can remember what I was taught way back in 2013, it is about intangible assets, and intangible assets can be developed internally. Like when you develop softwares, that's IS 38. You can develop softwares. Then for the football clubs, you might be having like the players, those football players, their contracts, they can be IS 38, but also they can be, yeah. So those are intangible assets. You can develop a website, as I've said, you can develop softwares. Those are intangible assets. You can develop certain vaccines, you get it. Now, like COVID vaccine and others, the rights over those vaccines are intangible what? Assets. You can have franchises, you can have copyrights, you can have patents. Now, some of those intangibles, some of them are purchased. Others are internally developed through R&D, research and development. Now, if they are through research and development, IS 38 requires that we expense the research costs. Research expenses are expensed. So as an auditor, you're going to one, get the invoices for those research costs, confirm the amounts, and the amounts that have been taken to the profit or loss amounts expensed, are they the same as the ones on the invoices? So you are inspecting the invoices to verify the R&D expenditure, because the standard requires expensing the research costs. Why do we expense them? Because we're just trying to find out whether the asset will work, doing the background work and all that. So we haven't really started developing the software, the vaccine, and all those other intangible assets. Then development costs, for them, they're supposed to be capitalized. They can be capitalized. But when do we capitalize them? We only capitalize them if the directors become confident that the assets, the intangible asset they're developing, e.g. website or software, will be completed and it will be ready for use or sale. And it's also technically feasible to complete that asset. The management has intentions to complete the project, but also it is probable that if they complete that intangible asset, it will generate future economic benefits to the company, and also its cost can be measured reliably. So if you find that development costs you're incurring to develop a vaccine, you've hired scientists, you've bought equipment, those are the development costs. You are paying those scientists. So when do you start capitalizing those costs? If those points are in place, directors are confident that the asset will be completed for sale or use. It is technically feasible. They have intentions to complete. Costs can be measured reliably, and the asset can generate future economic benefits. Then they capitalize. But other than that, if you find that the directors are not yet confident, then you don't capitalize. You also expense development costs. You only start capitalizing them if the directors are confident of all those matters. And then we are going to recalculate the amortization. These intangible assets after capitalizing, and they have started. You've started using them you start capitalizing them also. Sorry, you start amortizing them. Amortization is same as depreciation. For tangible assets, it's depreciation. For intangible, it is amortization. So you get the cost of the asset, then you divide by the useful life. So you're going to check whether they're being capitalized. You can calculate the amortization as it was for depreciation. And when it commenced, when did it commence? It must commence when the asset is in use, or it is reasonable to commence. Now, those are for internally developed intangible assets like softwares, like websites, like vaccines and others. But there are also intangible assets which we just buy, like goodwill. You never purchased goodwill. In IFRS 3, when you're doing in consolidation, you remember. For goodwill is when your father-in-law asks you 10 cows. For you've seen other intangible things in the lady and you pay 15 cows. They have only asked for 10, for you take 15. So the value of the lady is 10 cows. But for you are seeing other value in that lady, which is intangible, which other people cannot see. Then for you take 15 what? Cows. You are paying for a lady a price higher than the fair value. Her value on the market, her fair value. Fair value as per IFRS 13 is the value at which an asset is exchanged or a liability settled. So you are going to exchange that lady at only 10 cows. That's what the father wants, 10 cows. That's her fair value. That's her net fair value. The value of the physical asset. But you end up paying for 15 cows. So the extra is for the intangible. Is for the intangible, which you call goodwill. And you only record that goodwill after purchasing the asset. You get it. So that's why some parents don't want to sell their daughters. For them, they just give for free. Others like that. So we're saying that is how goodwill arises. You're selling your asset at a price higher than its actual value. So how do you audit this? You're going to get the value, the fair value of the asset. You can possibly get it from the sales agreement, and then look at how much they paid for it. How much they paid for it. The purchase consideration, the money they paid must be more than the value of the asset. Like in the balance sheet, the value of the asset on the market, you can even make inquiries. That at that time, how much was this asset? 10 million. But they paid for it 15. So the 5 is the goodwill. So as an auditor, you agree the purchase consideration with the sales agreement to confirm that the two are not the same and the purchase price is more than the value of the asset at that time. Also, you check the reasonableness. You find that the asset value, they have put a goodwill of 20 million, but is it reasonable to add all that 20 million? Then you need to recalculate goodwill also to verify its accuracy. And then also check that the goodwill is tested for impairment. You know, as per IFRS 3 and IAS 38 and also 36, sorry, it requires that we impair these assets, we check for impairment. There are many factors that can lead to impairment, changes in technology, the market conditions and others, they can cause impairment. So we shall check. Accountants are supposed to check for impairment and impair those assets. Then for auditors, we check whether the assets were tested for impairment. There must be a report, of course, on that. So any question on how we audit intangible assets? For other assets, the tests are the same. Others like patents, like copyrights and others. So any question on intangibles? So if you want us to stop recognizing ladies as assets, then they should stop paying for them. They should just be giving away. And there will be no issues, but that debate will always continue until when they stop asking for assets. But when they continue asking for assets, then for us in accounting, we shall see as if you are sustaining a value. Yet somebody is saying they're invaluable, yeah? So if they're invaluable, they should stop attaching a value. They just ask the man to bring what he can. Then there we shall not. But as far as they put a value, so we continue. That's a by the way. That's just a by the way. Don't get annoyed. Just a by the way.
Okay, sir.
For us, we shall continue asking property for our ladies, for our girls, so that they don't just take them for free. So there's a question here of Humura Limited. You can look at it in your free time, in your discussions. We got the last part. We are almost ending, like in the next. I think you have another engagement, so we should be ending soon. Let's just introduce this. The other asset we are auditing is inventory, IS2. So we got audit of inventory. Who can remind us IS2? We're auditing IS2. Who can remind us what it's all about?
Inventory should be recorded at a lower cost and less realizable.
Then talk about FIFO, LIFO, and AVICO. Which ones do we use?
FIFO.
We are supposed to use.
I think we use FIFO and AVICO. LIFO was scrapped off.
Okay. So these are the summaries of IS2. We're saying IS2 we mean inventory. Inventory can be raw materials, it can be work in progress, it can be finished goods. That's how it is defined in the standard. Then the standard only allows FIFO and weighted average cost method to determine the value of closing what? Stock. The standard allows measurement, and subsequent measurement is the law of cost and net realizable value. Because subsequently, after buying inventory, you attach a selling price, or after producing the goods, you attach a selling price. So cost is the amount you have incurred to buy the goods or to manufacture those goods. Then NRV is the amount you're likely to sell the goods less the selling costs. So we take the lower. We take the lower to avoid overstating inventory. Then in case there is a loss in value, loss in value arises when the cost is more than the NRV. You purchased inventory at a high price, but you're selling it at a loss. So if there is a loss in value, it's supposed to be written down, but you only write it down with board approval. Then closing stock, you must do a stock take. At the end of the year, do stock take. In cost accounting, they tell you that you can do perpetual counting or periodic. Perpetual is when you keep counting, like every quarter you count, or every day, or every month. That's perpetual. But periodic, you only count at the end of the year. Then inventory counting instructions should be there when you're going to count. We shall look at them later on, which instructions are supposed to follow while you're doing the count or the stock taking. You write off obsolete or damaged inventory. Then IS2 tells you that also shows you the components of the cost and NRV, how you arrive at cost. Cost, you can use standard cost, remember them in cost accounting. NRV, it's all about the selling price minus the selling costs. Source documents must be there for inventory, like LOPOs, like invoices, receipts, and DNs, and others. You must make disclosures in line with IS2, require certain disclosures of all these things in the notes. There should be a policy manual for inventory, having instructions on how inventory can be transferred from one place to another and others. How it can be issued. That we have like under source documents have like SIVs, the stock issue vouchers. Stock issue vouchers. This is used when you are issuing stock. We have the bin cards. You've been in internship, you've looked at all these things. Bin cards, the stock transfer form vouchers. The DNs, delivery notes, the GRNs, etc. Invoices, get passes. There should be a get pass for inventory being moved out, etc. Now, these are some of the requirements in IS2. So you still use the other same tests. You start from analytical. So I'm assuming you are in an exam. What do we compare? What can we compare on inventory? Remember, we compare opening, closing balances. What else? Who knows a bin card? You can explain a bin card. Somebody's asking what's a bin card. A bin card is a card, as you can hear. A card for every inventory item in the store. For example, let's say in your store you have pipes. Pipes are of different types. For example, you're a store, you are selling hardware. You have pipes, you have cement. So cement, you have a bin card. That bin card has the name of the stock item, the code. It has the ins and outs. So when you bring in stock, you record on a bin card the purchases. Then when you issue, you subtract and then balance. There are 3 columns: details, ins, outs, balance. So when stock comes in, you write the name of the stock and what has been brought in, amount. Amount, not amount, but number. On the bin cards, only have numbers, don't have amounts. Amounts are in the stock ledger. Only numbers. 100 bags of cement on 30th July. Balance 100 bags of cement. Then tomorrow you issue 20. So issued, you show. Balance, you put. Like that. So a bin card is supposed to be corresponding with the physical stock all the time. And each item has a separate bin card. Each item should have a separate bin card. So, as I said, comparison, you can start by comparing the opening stock The opening inventory for the current year with the previous year. So like the way we wrote, we shall do opening and closing. We shall do the ratio. Which ratio is here? There is turnover, there is inventory turnover. The rate at which inventory is replaced. This level should be high. If it is low, there's a problem. So there will be issues with low turnover. That means you're not selling. Inventory days or period, remember how you compute it. There will be issues with increasing days. So compare the inventory period for the current year with the previous year to establish increases in inventory period or inventory days. So if the days are increasing, there's a problem. We are staying with inventory for a long period, which could lead to obsolescence or loss in the value of inventory. Yeah. Then you can still compare. We are looking at what you can compare. We said you can also do a trend analysis for closing stock, like over 3 years. Has it been increasing or reducing? If it has been increasing, that means there's a problem. Stock is not being used at the rate it should be used. We can also compare total inventory for current year with the previous year for possible overstatement of stock. You know, stock can easily be overstated. It's one of the figures people play around with when they have eaten money. Because when you overstate stock, it leads to overstatement of profits. So if you find that closing stock is increasing, it is an indicator that these people might be intentionally overstating closing stock. Whenever you overstate closing stock, profits are overstated. So if somebody wants to get a bonus, he doesn't go very far, he just overstates closing stock. The bonuses will be there for him because the profits will be overstated. And he knows that the board members can't go to the stock to verify. So the key risk, they can also ask you key risks of stock. Key risks is overstatement of stock, closing stock, overvaluation. Here, this one comes when cost is below NRV. Like when we went for COVID, the first lockdown, people left their stock in the shops. They came back when it has been spoiled, or it was already off or outdated. Yeah. So meaning that stock had lost value. But if they don't write it down, then it will be overvalued. Also theft. Stock can either be stolen. What else? What are the other risks of overstock?
Obsolescence.
Obsolescence.
Shrinkage.
What is shrinkage?
It may lose weight.
Okay, like if you got chicken and you're dealing in chicken, there will be weight loss, which leads to loss of value. Okay, etc. You can go now to after comparisons, you go to recalculations, you can analyze the inventory account and others. So these are some of the tests for inventory. These are the assertions you are verifying, then these are the tests. For existence, quickly as we go going, observe the physical count. You can't observe the physical count as an auditor when the accounting stock to confirm whether items are there. So auditors are allowed to go and observe the count, or they can send their drones, they go and take pictures. But you must observe when they're counting. If Capital Shop is doing their inventory year-end count, you go and be there and see. Also, you can select a sample of items from the records and physically inspect them. Select a sample of items from the records, like from the stock list, and check whether it is there, whether it is available. And then for inventory with third parties, you can also write to those third parties to confirm that they are holding that inventory. For example, our inventory might be in Mbale with our distributor. So if I'm auditing you here, I'm going to write to your distributor, tell me some of our stock is in Mbale. We sent it to the agent. I write to that agent. So that's for existence. That's for existence. You're going to observe the count, see what is being counted, whether it is there. You can select an item from the records. The records specifically here, we mean the stock list, the final inventory list. And GL. So select from here and physically confirm that. So you are moving from the document to the physical. That is now existence. Yeah. Then for completeness, you reverse these ones. You start from the physical count and then see what they have counted. Is it in the final inventory list? So go to the store and point on something, point on a physical item, ask them to show it to you on the list. Then if it's on the list, then it has been completely recorded. Still for completeness, you can write to third parties. They confirm to you that they're the ones holding the what? The stock. This is external confirmation. Then you check the profit we are making on the stock. If the profit is increasing, that is okay, but the problem will be if it is decreasing. Yeah? If the profit is increasing, that means the stock was there and it was sold, and they're making a what? A profit. And then these other tests, rights and obligations. Like for stock in transit, you're going to look at the supplier documents, because supplier documents come before the goods arrive. Yeah. Or even consignment stock. Consignment stock, we mean stock which is for agents or for third parties, like that. So you're going to go through this. Then when you come back, the next time we meet on Monday, that's on Monday. On Monday, we shall continue with this inventory. You need to do a lot of reading. This paper needs a lot of reading and discussions. So we stop here for now. Enjoy the rest of your weekend.
Excuse me, sir.
Yes.
Yeah, the notes you shared last time don't include the edits make here in class. I request that you save and share with us these notes with these edits because they help us so much.
But these are like explanations which I write on the whiteboard when it's a physical class.
Which is okay, sir, when you share with them.
Okay, I'll share.
Thank you so much for watching. Make sure you subscribe to the channel.